Luke, thanks for joining me on the podcast. I'm excited to have you here to talk about your story with Renjoy Short Term Rentals and some cool stuff about Helocs. But first, let's do a little bit of a background about you and how you got to where you are now.
Yeah, absolutely. My name is Luke. I'm the co-founder and COO of Renjoy. I was born in Denver, grew up there, but been down here in Colorado Springs for about 8 years now. My wife grew up down here. We've been down here about 8 years on the west. We've been living on the west side since 2019, so almost 5 years now. We do have one son. His name's Lincoln. He's almost 2 years old. And then we bought our first property back in 2017 and been really actively investing and been house hackers since 2019.
Awesome. And your wife Lexi has been on the podcast just before. She
Yes.
is a interior designer, which has seemed like it helped a lot when you started your real estate journey of her designing all the properties.
Yeah, absolutely. It's definitely one of those things that just kind of came together for us. So.
So once you got into the idea of real estate, how did that kind of happen, and why did you land on like house hacking your first one?
Yeah, so we bought our first house in 2017, and that was really because of Lexi. At that point, we weren't even married yet. We weren't even engaged yet, but we had come back we did some traveling right after school, right after college, and we came back and we're living in her parents' basement for about 6 months, and with the intention of saving up and getting our own place. And she was pretty adamant that she didn't want to rent, she wanted to buy, and that's a lot from her family. Her parents and her brothers are entrepreneurs and have always owned property and had rental properties and things like that. And so that was very much her mindset. She wanted to buy a place, which scared the heck out of me. But as usual, she got her way and we bought a
Yeah.
house.
How was that
Um,
feeling of like, okay, we're gonna get married soon, but like we're gonna buy a house first? Is it like a lot like, oh man, like I'm really going all in on this girl?
oh yeah, well I hadn't even, like I said, I hadn't even proposed yet because I was like, I don't want to
Yeah.
propose while I'm living in her parents' basement.
Yeah.
And yeah, but there was definitely the part of me with the extreme commitment issues of like,
Hmm.
are you saying we're gonna buy a house right now? Are you sure?
Yeah.
But no, it was obviously so glad we did. It was definitely the right choice. And so
Mhm.
we lived there for a couple of years, and besides that, we did have a guy living in the basement. So technically we were house hacking. We had someone renting out our basement, but it was more of like we couldn't afford the mortgage, so that's just what we were doing.
Mhm.
And coming up into 2019 is when we had some friends that had started getting into real estate. Now my business partner, Michael, he and his wife, they bought their first house hack downtown Colorado Springs, and we kind of thought they were crazy at first. They were like, "You're gonna do what? You're selling your nice house up in Monument, and you're gonna fill your house with roommates and rent out this house behind your house on Airbnb? Like that sounds like chaos."
Mhm.
But he kind of, one, showed me how much money he was making off of it, and two, he had really gotten into, like, a lot of people got started off with bigger pockets on the podcast and all that. And so he started getting me listening to those, and gave me some pretty impactful books. And then kind of through that, we're like, all right, let's give this thing a shot, and ended up buying our first, what I consider our first true like investment and house hack at the end of 2019.
And so that one, what was the purchase price in 2019? And did you keep your first one or just turn that one into a rental, or did you sell it?
Yeah, so we did keep that one for a time. Turned it into a long-term rental. Had tenants in there for about a year and a half, and then we did end up selling that house. But at the time, the house we purchased in 2019, bought that one for 400, and it was in Old Colorado City.
Okay. And it was that, did you split it, do anything kind of creative rehab wise to it? Or was it just pretty much move and ready?
We definitely had to do a bit of reno in the upstairs unit that we were going to be renting out. Nothing over the top, but we put in some new countertops, new backsplash, and painted the whole place. And at that point we
Mhm.
had no money, so we did it basically all ourselves. say the one big creative thing we did at that house was we split up the backyard. The backyard was technically just shared at that point, one big space. And so we did put in a big fence down the middle and ended up actually pouring a pad for a shared hot tub as well. But other than that, it was split up really well. One of the cool things about it was we bought it as a single family home. It was technically categorized as a house with a mother-in-law suite. But for all purposes, there were separate entrances, separate hot water heaters, separate furnaces, all that kind of stuff. And so we were able to live in the smaller unit downstairs and rent out the upstairs.
Did it have the correct zoning for being like a duplex per se, zoned R2?
Yep, zoned R2, and especially with us splitting up the yard and kind of the use we've had for it, we've had it appraised a couple of times since, and they've appraised it as a duplex since then. But the benefit of being able to buy it as a single family home was we only had to put 5% down at the time when we purchased it.
From the get-go, were you like, we're definitely making this a short-term rental, so you kind of were looking for good properties that would be able to be used in that way?
Yeah, that was definitely the focus. We saw our friends doing it and having a lot of success. And the other thing too is Lexi and I were fortunate enough to do quite a bit of traveling kind of as we were growing up in college. And like I mentioned, after college, we traveled quite a bit. And so we'd stayed in Airbnbs all over the world and hotels. And we loved the, being able to nitpick all the stays that we had around and, stay in a hotel. I'm like, well, why aren't they doing this? They should be doing this there. They should be providing this. And so when we finally had this opportunity of like, oh man, we actually get to create our own and do all these little things that we think of, that was really exciting to both of us to be able to, do something we're going to enjoy, as well as, ideally be able to turn a profit from an investment. So
for the hot tub that you've been put in the back, did you notice, like, just from getting feedback from Michael that, oh yeah, you definitely need to put a hot tub, it'll increase the value and the like attraction that you'll get for your bookings as a short-term rental?
Yeah, it was always part of the plan right from the beginning. And this house has a killer view out of the backyard of Pikes Peak. And so there was kind of a perfect spot to place it where you can sit in the tub and look out at Pikes Peak. And so, yeah, it was kind of a no-brainer. And it's definitely been part of the success of the unit long-term.
What were some of the challenges once you started it? Do you have to manage it yourself at this point? You didn't have any type of property manager.
Yeah.
What would you recommend someone to do that now when they first get their first one up and running? And what did you learn from that experience?
Yeah, absolutely. I would recommend that people try and do management themselves, as long as they're willing to put the time and the effort in to do it right. Some people just don't, like at Renjoy, we've got some clients that I'm sure would be fully capable of managing their property, and they're house hackers. They live there. But we got a lot of military clients, right? And during the day, they're in some bunker where their phone is locked up and they absolutely don't have access. And you have to be available for guests, pretty frequent, basically 24/7. So if you can't do that, it doesn't work. And there's just a lot that goes into it, right? Finding and managing your cleaners and managing your listing, making sure your listing stays updated, making sure you're managing your pricing actively to hit those optimum rates. Otherwise, you're just going to see subpar returns if you're not putting that time and effort in. But if you're willing to do that and you've got the time, I say absolutely. Property managers, we take a healthy cut of what's coming to you, but ideally we give it's because what we do is hard, and ideally we're given a lot of time and stress back. But to especially the first time house hacker, that money may be worth it. Your time may not be that valuable yet that you can start giving it away and affording to pay our commissions. So, and that, and just having a perspective going forward is, when you get to the point where you want to hire a manager, having the perspective of how things actually work in a short-term rental. We get a lot of people that come in and they've never done it before and have a lot of assumptions, but a lot of those are often incorrect, and it creates a more stressful relationship, and it also makes it difficult for the client. You want to be able to, at Renjoy, obviously we try and do the best job we can, but I think there's an element as an investor, you always need to be managing your manager. And if you've got some of that experience and those expertise to actually know what's going on and be able to identify problems and get ahead of them and address them with your manager, I think that's really important, just prudent thing to do as an investor.
Hmm. Awesome. For when you started taking on like your first short-term rental and then you slowly scaled to several more,
Mhm.
how did you feel when you didn't have like a locked-in lease? Because a lot of new investors are like, oh yeah, I'll just put a lease in and then I know I'm guaranteed or at least somewhat guaranteed that they're going to pay me every single month. But with short-term
Yeah,
rentals, it's like you got to fight to kind of stand out, get people's attraction to your listing, and you're not technically guaranteed anything at the start of every single month.
totally. There's a learning curve, right? If you don't know what you don't know, and again, especially if you're going into it blind, and especially if you don't put the effort in to get the education, you could be totally mispricing stuff, whether under or overpricing. You could be handling situations poorly. You don't know what you don't know. Um, so that can make it really tough. Um, Lost my train of thought. Where were we? Yeah, keep it going.
Yeah. So when you were doing your like first one to make that jump, was it Lexi was helping you pretty good? And what type of time commitment did you have? Because you were still working on
Yeah.
your other job at that time too. So how was it juggling with those items?
Yeah, it was definitely a balance. We found at the time, one cleaner in particular that we really liked, and especially as we scaled to having more units that we were managing ourselves, we put a little bit more responsibility on her, paid her a little bit of an extra bonus each month to help us, things like just going to Costco and doing the shopping, right? Providing all
Hmm.
the consumables and stuff for guests, taking those kinds of things off our plate. And then especially as we grew to more units, that cleaner couldn't handle all the cleans. And so put the responsibility on her to find other cleaners to cover cleans when she couldn't do them herself. So those things were really important. And finding that person definitely isn't easy. But if you can find that kind of person, that took a lot of stress off us for sure. But then there's still that, component of just being always available for guests, getting phone calls in the middle of the night and having to go deal with things. And, if you've got a handyman that you can rely on and you can have on call, great. But again, that's going to be expensive. Handymen aren't cheap, especially if you're calling them in last minute. And so, I had 2 a.m., trips to our units to go and unlock a door or, fix a toilet that was overflowing. It's just kind of part of the game.
So you did your first couple short-term rentals going, and you started to
Yeah.
scale to several more. Before we talk about how you scaled using Helocs and stuff like
Yeah.
that, how did Renjoy kind of come to be with you, Michael's, and Jacob's experience within short-term rentals?
Yeah, absolutely. So Michael and I have been doing short-term rentals, kind of side by side for a few years. We had each been acquiring new properties, adding units. Um, and kind of during that time, we found a group of guys that we started a mastermind with. And our third partner, Jacob, was one of the guys in that mastermind. Jacob he had dabbled in short-term rentals a little bit. He owns a property up in Buena Vista, things like that. But he was more focused on flipping and doing some of his long-term rentals. Kind of got a glimpse into what Michael and I had been doing and some of the returns we were seeing. And he kind of started putting the bug in our ear about doing something more with it. So we had toyed with the idea of like, do we start a management company or what do we do? And but we're like, it's just not worth it. Like you said, we're managing our own units, plus we had W-2 jobs, and like, man, that just sounds like a whole nother thing. Through the mastermind, we ended up finding a short-term rental property in downtown Colorado Springs that was a great opportunity, and the three of us ended up buying it together as equal partners. We still own that property today, and that one kind of ended up becoming the catalyst for us to have a more serious conversation, because it was this weird thing of like, well, are you going to manage it? Am I going to manage it? Seems stupid to hire an outside company to manage it. And so
Hmm.
that's when we started having the serious conversation. And we looked around, we liked the idea of, well, maybe we even just hand off all our units to some manager that we like. And honestly, we just didn't trust any of the managers. The management options that we found, like, okay, we're going to pay a 25% commission and we're going to take a 25% hit to our revenue because they're not doing a great job. Like,
Hmm.
that just that doesn't sound like a good option. And so it started from there. And then we started finding people that were interested in the same thing, looking for management, and yeah, the rest is kind of history.
Your first cleaner that you ever had, did you kind of like just kind of round up all your cleaners? You're like, yeah, we're starting this thing. Come on, we'll make it work. And is that cleaner
Yeah.
still with Renjoy today?
She's not. No.
No.
She was for a time, and yeah, but it was, yeah, that's exactly what it was. It was Michael's people that he had and my people that I had, and we're like, yep, hey, we're starting a company, and come on, let's do it. And that worked for a time, and and then as we've grown, things have changed. So
Yeah.
yeah, it was a chaotic time for sure.
So within Renjoy, you each kind of have your own roles that you specialize in. What's your role within Renjoy, and what do you mainly focus on?
Yeah, absolutely. So as we've grown, we kind of all started, wearing 1,000 hats, and as we've grown, trying to wear fewer and fewer hats and focus in. So I've got a couple of areas of focus. One of my big ones is we call it owner advocate, but I do all of our owner relations. So I've got the primary relationship with all of our homeowners, and do the bulk of the communication with them. So that takes up a good bit of my time, and then I also act as our COO, overseeing our larger operations departments, including cleaning, maintenance, guest experience, that kind of stuff.
Mhm. For owner relations, whenever someone gets mad or they're like, "Oh, are we not making as much?" They come to you basically.
Yeah.
What's like the common like thing you tell them? You kind of like analyze their property to see how you can improve it. Are a lot of them like not willing to put up the money to make those improvements?
Yeah, it's a challenge. One thing that we've tried to do from the beginning is have a focus on more premium rentals, and a focus on investment-minded owners who, maybe they don't have the cash to do all the improvements right now, but they're at least open to it, and it's like an ongoing discussion, an ongoing work in progress. Um, that said, we've made some mistakes there, and there have been some owners that didn't fit. But really, the complaints that come along are anything and everything in between. Um, all the owners have different priorities. Obviously, we think as investors, we're like, what else matters but revenue, right? What
Yeah.
else matters? At the end of the day, that's what matters. And owners definitely care about that, but owners have different priorities. Some of them really want guests to just have a great experience. Some of them are very concerned about the cleanliness of a place, and like these are all factors. But to us, and what we stress to our owners before they even sign up with us is, listen, yes, these are all important things, but they all add up to the highest possible revenue. They're all just factors, and putting one over another, putting cleaning over another, putting guest experience over revenue, putting any of that kind of stuff over the pursuit of maximize revenue is going to lead to less revenue. And so we make sure our owners understand that going in, that's the mentality we come at things with.
hmm With guest reviews, especially on Airbnb and VRBO, that's kind of a big indicator on like the marketing, especially on those websites, since they get so much demand to it. Um, does that must have a big effect on the revenue? And do you really strive to get those 5-star reviews so that the property does stand out?
Yeah. Um, This is a nuanced topic for sure. Reviews definitely have an impact. If you're sitting at 4.5 stars, consistently, guests are going to be pretty wary of booking you, because there are so many that are above that. And it's not like Yelp, where 4.5 is actually a pretty darn good score. On
Mhm.
Airbnb, a 4.5 is like run for the hills. Um, but then once you get, you'd be surprised once you get hit that kind of like 4.8 and above threshold. Yeah, it's really great to be at 4.95, but there's definitely a balance. If we've talked to clients where they've been self-managing for years, and they're like, look, I have 400 reviews and they're all 5 stars. That's a red flag to us. There's probably
Mhm.
something wrong in their management style. And sure enough, we go and we look at their revenue, and it's terrible. And it's because they're over accommodating guests, and they're not charging enough, and so
Mhm.
guests are if they have this amazing place and they're paying half of what it's worth, and then with any little complaint, the owner is running over there or they're issuing a big refund,
Yeah.
you're going to maintain those 5-star bookings. But again, it's a disservice to their revenue. So.
Gotcha. So now we talked about Renjoy a little bit. Let's go back to how you scaled during that process. And you utilize a lot of Helocs. Some call you the Heloc king, I hear.
Heard. I think you started that, but yeah.
So what's so cool about Helocs, and how can they be utilized in the proper way to scale a rental portfolio?
Yeah. So it's been a really powerful part of our real estate investment journey. First found out about them actually on our very first property. The property, we'd been living there a couple of years, and our real estate agent at the time, we're like, hey, we've got a little bit of cash, but we don't really have enough to do what we want and to get the kind of property we want. And so, but we'd been living in this property for a couple of years. It had been seen a couple of great years of appreciation. And so that's when we went to our lender, and yeah, we learned all about the Heloc. And then since then, I've gotten a Heloc on all but one property that we've owned.
Would you recommend getting it like right before you move out? At least setting it up, at least you have access to that equity?
Yeah, absolutely. It depends on your goals, obviously, and how long you plan on being in a property. But yeah, there's definitely a lot of benefits it's a lot easier to get a Heloc, and you can generally access more equity and generally have lower rates if you're occupying a property. So you just want to, it's a great idea to do that. Obviously, probably don't want to let the Heloc lender know that, if you're planning to move next month, they probably wouldn't look too kindly on that. But once the line of credit is closed, that line of credit is open for you, and you can do with it what you want. So,
So you're basically borrowing the equity or even appreciation that you get within the property, and it can go up to various LTVs throughout, depending on your lender and stuff. But what's the most common that is seen out there, and what's the most that you've ever seen or done personally?
Loan to value. Yeah, I would say if you're owner occupied, 90% is pretty common. You can find that at quite a few lenders. I have seen in the past, there have been places that have done 95, and there was even a time when a place was doing 100% loan to value. I haven't heard of anyone doing over 100%, but right now with rates the way they are, I think that one lender we knew about, I don't think they're doing 100% anymore.
Yeah, they are. I think they're dropped down to 95 is where they're at. That's SSFCU. That's where they're at.
Yeah. But, and that takes, it's easy to go and get those things. But there's definitely some risk involved as well. You're tapping 100%, especially if you're doing a full draw on your Heloc, you are tapping 100% of your property's value. And so if there are big shifts in the market or big shifts in your financial situation, you don't really have the option to sell that property to recoup any losses. So there's definitely risk involved, and then you're paying interest on them as well. One of the great things about Helocs is that typically for the draw period, which is generally about 10 years, you can make interest only payments on what you're lending, which means that you're paying quite a bit less than you would on a standard loan on a monthly basis. And so if you can find a way to use that money in a better way than whatever interest rate you're paying, that's kind of the goal. Few years ago, especially when we were doing most of ours, rates were so low, and so we're paying 3 or 4% on this money, and it was like, yeah, I think I can beat 3 or 4% with this money out in the market. I'll throw it in an index fund and more than that. But now rates are higher, and so some of my Helocs, and most Helocs are variable rates, so they're going to fluctuate as rates fluctuate. And so some of these ones that I was paying 3.5% on a few years ago, I'm up paying 9.5% now, and that it makes an impact. I was paying $300 or $400 a month, and I got one that I'm paying $1,200 a month on right now, and that's interest only. So that's brutal. That definitely hurts your bottom line. So got to factor those things in. And a lot of places do offer fixed rate HELOCs. Usually the rates aren't quite as attractive, but in certain environments, looking back now, I wish at that time, I wish I had taken, they're like, oh, 3% variable or 4% fixed. I'm like, variable, absolutely.
Yeah.
And now looking back, I'm like, man, should have taken fixed. So
Yeah.
definitely something to consider.
Why would you go with a HELOC route instead of just refinancing the property at
Yeah.
that time?
Yeah, for sure. So the biggest thing is generally you've got more access. You've got more access to equity. Refis, depending on the property, you're probably looking at only being, if you're doing a cash out refi, you're probably looking at only 70 to 80% loan to value, where again on a HELOC you can get up to 90% pretty easily. So you got more access to equity, and just the flexibility as well. You can draw on that line, pay that line back as much or as little as you want to. I tell people, especially even people that aren't as motivated and as focused on investing, if they're sitting on equity in their home, like, go get that HELOC. Cost you a couple $100 in origination fees to open it up, and you can literally let it sit there and for the entire life of it, never touch it, and you won't pay a dime on it. But at least you've got access to that money. You've got access to that equity for an emergency or whatever else comes up. Don't buy a boat like the commercials tell you to, but just having access, that's your money that's just caught up in this property that's unrealized. So
Would you think it would be smart to open up your HELOC? Maybe you don't touch it, maybe you use a little bit of it, but kind of have that as your reserves per se for a rental property in case something major goes on with a furnace or water heater or roof or something like that?
Yeah, absolutely. I mean, I think it's always probably a good idea to have, if you're being, going by the book and being more conservative, I think it's probably smart to at least have a little bit of cash stored away, just because you never know. Banks can cut off those lines of credit. A few years ago when there were some issues, I think it was Wells Fargo came out and just did a blanket, we are closing all lines of credit. Basically anyone with a balance ended up, they were no longer, their draw period ended and they went straight into the repayment period. So that's definitely possible, and the lender, if they, for instance, like if you got it as owner occupied and for some reason the lender found out that, you no longer lived in that property, they would have the option, never heard of it actually happening, but they would have the option of calling that, shutting down that line of credit. Suddenly you have no longer have access to that line of credit and you have to start making payments on whatever balance you're carrying. I think it is prudent to keep a little, at least some cash available. But yeah, in general, it definitely does leave you a lot of room for those reserves. Yeah.
For that draw period and then the repayment period, in the draw period, it's just the interest only payments that you're required to make every month, correct?
Yep.
And then once you go into the repayment period, that's when it becomes like your standard, like 30-year fixed mortgage where you're paying the principal and interest during that time period.
Yeah, exactly. If you still have a balance, right? And that's the thing, during the period, $1,000 line of credit, you've only drawn 50, you're only paying interest on that 50. And maybe over that time you pay back another 30, and then you go to the repayment period. Now you've only got 20 left, and they're going to amortize that 20-year, that 20K out. It depends. Usually it's talked about like a 10-year draw with a 10-year repayment they'll usually talk about it as like a 10-10. So you can get a 10-10. I've seen 10-15s. I talked to a place, a little guy that had like 10-20. They'll places that do 15 years. You can get a 15-20. There's all, it depends. It all just depends on the lender and what they're doing. Obviously the longer draw period and the longer repayment period you can get, the better.
Would you, when you look at it, do you plan to go into that repayment period, or could you possibly refinance your whole entire property and pay all that off?
Yeah, I think that's the thing. Like, 10 years, obviously. And like I said, I was looking at a one of these a couple months ago, and they had a 20-year draw period. And I'm like, what are the chances that I'm not going to refinance my property over the next 20 years, even with this extra money drawn? So yeah, I think there's definitely a good chance. And again, it also depends on rates. Again, back when loans, when we were paying 3 or 4% on these things, it's like, it would be stupid to pay this back. I'm going to draw my full amount and I'm going to use that for investing because the cost of the money was so cheap. Now at 9.5%, 10%, if I've got extra cash, I may actually consider starting to pay some of those down because the monthly payments are substantial. So again, it's all about, can you take that money and can you get a higher return than the interest you're paying on it? So yeah. And I'll say too, some lenders, depending on what let's say you've got your HELOC, you got a 10-year draw period, you're 5 years in, and hey, my home's appreciated an extra 100 grand over the last 5 years. I'd like to tap more equity. You can go back to that lender and say, hey, they'll probably have you do a new, some will actually extend the line of credit, but more likely they'll open you a new line of credit, basically pay off the old one with the new one, and the new one's bigger. So.
Gotcha. Would you, let's see, you've still been house hacking, even though like you started house hacking and now you're still house hacking, correct?
Yeah. Yep.
How many properties do you have so far, and what's your total rental count?
We have, not including the property I own with my partners, just personally, Lexi and I, we own 4 duplexes. I guess 3 duplexes, and we currently live in a house and cottage.
Gotcha.
So we got 7 rental units.
With the house and cottage compared to the duplex, I know you live in the house and cottage, but do you see it as being a little bit better for short-term rentals since it's completely separate for the most part, or compared to being like up down, you have the noise and interaction with in between guests?
Yeah, I mean, it depends. Yeah, I mean, there's definitely a little bit of a bump, depending on how it's laid out, and depending on what amenities they're still sharing. And then, yeah, I mean, the up-down duplex can also obviously present issues with, just noise transfer and guests being bothered. I think, in general, basement units tend to not do quite as well. But we've also got a side-by-side duplex that's got nice thick concrete walls, and we lived there obviously for a while, and I mean, we never heard the people next door, and we had separate yards for them and everything. So it's like, I mean, it didn't really feel a whole lot different. The house cottage is great for us now. Again, we've got a son, we've got dogs, and a little less willing to compromise than we used to be on our overall living comfort. So
not going to live in a basement unit anymore.
No, those days I think are behind us at the moment. You should do it while you can, but
yes.
But yeah, once you start getting all those other family things going, it makes it a little more difficult.
I remember what I was going to ask about Helocs again, to bounce back to that topic. The qualifications for a Heloc, are they similar to when you're purchasing a home, or are they like slightly different to where you don't need to have like perfect credit?
Yeah, it really depends on the lender. It also depends on how much equity you're trying to access, and what your credit looks like and all that. And it depends on the just the overall financial climate. I've had ones where, I mean, it was basically like getting a mortgage, where they're asking for all the same documentation, and you're having to 2 years of tax returns and pay stubs and all this different stuff. But then I've also had one. I've had one where they asked me for 2 documents and we closed in under a week.
Oh my, which one was that?
That was our primary home, and that was with Ent Credit Union, and it blew my mind. I called them one day and said, hey, I want to get a HELOC, and they said, okay, great. Like, we don't need an appraisal because we saw you bought it within a year, so we're just going to use the purchase price. And they wanted my proof of insurance and my property management agreement for the cottage. And they're like, okay, great. Here we're ready to close, and so we can set an appointment next week, or we can actually just do it over the phone right now if you want. It's like, yep. And they're like, great, funds will be available to you tomorrow. It's like,
no way.
Literally Monday to Friday, and it was awesome.
Thing it's funny how each bank is kind of different in what they ask for qualifications, and sometimes like the local credit unions or banks like Ent can have the best deals and stuff like that to your area, unlike a big one like Chase or something like that.
Oh, 100%. If you're looking for a HELOC, I mean, don't even bother going to the big banks. It's all about the local credit unions, local banks. Actually, I said I was hunting for one a few months ago, and I have a spreadsheet. I called like over 80 banks, and every single one of them has completely different terms, different rates, different ways of structuring things, different requirements. So, if you've got more difficult situation, you need to get a little more creative. Don't be discouraged after the first bank, turns you down. Sometimes you gotta grind, and you gotta call around and make it happen. So.
Hmm. So where is Renjoy going to be heading to next with what you've built up so far? Where's the kind of trajectory Renjoy is going to be going?
Yeah, to the moon.
To the moon.
Yeah, no, we're excited about continuing to grow. We've become, I think, now the largest property manager in Colorado Springs for short-term rentals, and we plan to still, continue to grow here a bit, but definitely starting to look out of state. We've launched Florida earlier this year and last year, and we're going to be opening our first property in Arizona next month. So looking forward to taking, looking elsewhere, and also excited to get more involved in the tech space. In our industry, tech and software is a disaster. It really is. It's a mess. And so what's happened is we've ended up buying, creating a lot of our own tools and a lot of our own stuff in house. And so, we're excited about the possibilities of that, and with where the industry is going, what we might be able to contribute in that space as well. So, who knows? Sky's the limit. There's new things every day. So,
In Arizona, what city is that in that new property you guys started opening up
it's
there?
a suburb of Phoenix called Mesa.
Okay. Oh, Mesa. Got it. I'm from Phoenix. Kind of, my
Oh, cool. I
cousins
didn't know that.
live in Mesa, actually.
Oh, sweet.
Right
Yeah.
there. So, do you think you personally would buy in Florida or Arizona to kind of offset the low times in
Yeah.
Colorado?
We're definitely still feeling out Arizona a little bit, so I'm not sure, but Florida, yeah, definitely. A big reason we're looking out there, and something I would have done different in my personal portfolio, if I could go back a little bit, is buy in more diverse markets. Another great thing about long-term leases, as you mentioned, is what you're getting, and it's going to be the same every single month of the year. So here's my mortgage, here's my expenses, here's my income, and it's that simple. Obviously without dealing with vacancy and things like that. Short-term rentals are highly seasonal, particularly here in Colorado Springs. We've got big summers and we got low winters, which can make it really difficult to manage that money properly, and really even know what to expect year to year. The market changes. And so just because you made this money this year in this month doesn't mean you're going to make that same money the next year, the next month. And that's definitely another risk of owner operating, and not seeing those trends coming before they happen, not seeing those indicators. So yeah, definitely looking to find places like Florida that have more opposite seasonality, and that have maybe more stable seasonality, so that when we're getting the months that we're making no money here in Colorado Springs, ideally that's when you're making your most money somewhere else. And so I think a good balanced portfolio would actually see properties in more than one location. You have 2, 3, 4 locations around, with that seasonality in mind, to really balance your overall portfolio. But it's tough. That means you got to find managers in each of those locations, and that's part of what Renjoy is trying to solve for ourselves and for other investors. Is and I was always intimidated to invest out of state because I don't know anyone. Okay, great, this is a great appreciation market with strong rental rates, but I don't know anyone. I'm gonna look down a list online and hope I find a property manager to take care of this huge investment that I'm making. And so we're hoping to, all the great clients that we've built up here, being able to give them, they all have the same problem we do with seasonality. And so being able to give them the option of hey, let's all fix this together. You already know us, you already trust us. We're going to take care of you down there as well. So that's definitely a big goal of ours.
Awesome. Well, thank you, Luke. I thought it was awesome hearing a lot of the insights and information you have about Helocs and short-term rentals, and how well you've done without your house hacking journey so far. Is there anywhere where people can reach out to you if they have any questions specifically?
Yeah, I am not big on social media. I do have a Facebook page that is not checked very regularly. Honestly, best way to get
you still haven't friended me on Facebook yet. It still says pending.
Yeah. All right. I'll have to go check on that. Yeah, not big on social media. Probably easiest way to get in touch with me is through my email. It's pretty simple, just luke@renjoy.com. I'm on that all the time, so that's the best way to get in touch. I'd be happy to chat with anyone. They got, if they're on a Heloc hunt or they're looking into house hacking or they got questions about short-term rentals, more than happy to sit down and have a conversation. I'm passionate about helping people get going on their journey with real estate, helping them, make decisions towards financial freedom. So more than happy to sit down with anyone that's got questions.
Sweet.